All right, it is top of the hour. Thank you. All of our participants seem to be logging in. The Q&A section should be open for you. I'm going to wait just one more minute. I'll give you the general overview here. This should take about 30 minutes to go through rapid fire, the City Funds investor onboarding session here. I am flying solo today. My name is Sundance Brennan. Our investor relations specialist, Dion, is actually out of the office today. So you'll get a slightly different perspective for this week's webinar. If you have questions, please feel free to use the Q&A section there, and I will address those towards the end of the presentation for you. I do anticipate that this will go right around 20 minutes, maybe 25 minutes or so of actual presentation time once we get rolling here. As a quick reminder, this session is recorded. I believe you can see captions at the bottom of the screen as well. If you can't, when we upload this on the YouTube version, we'll make sure that captions are there for you as well. So we can make sure that everybody has access to see and hear and absorb all of the material that we have here. All right. I see lots of folks popping into the room now. A few late arrivals. That's all right. We appreciate you. We're just getting started. It is now 6:01 Central Time, and I do want to be mindful of the time, so we're going to get started here. So once again, my name is Sundance Brennan. I'm head of revenue here at NADA. That means I have a significant insight into not just the investor relations side of the business. So I'm happy to answer questions for you in that Q&A section about particular investments, rates of return. If I don't have the answer for you immediately, I'll make sure that I will follow up with you and get you all those answers. But I also handle the acquisition side of the business. So the originations, the home shares, we call that. So I interact with a lot of homeowners. So our platform brings together homeowners and investors. We're in a situation where everybody is happy. Investors get a nice rate of return. Homeowners get access to cash now that otherwise wouldn't be available. That's what NADA is in a nutshell. Like the overall business model, that's what we do. Now, this particular webinar is focused on city funds for our investors. So I'm going to start that presentation now. We'll start with just the regular onboarding type of a message here. So just a quick note about the mission itself. So we want to help real estate investors grow long-term wealth by redefining real estate investing through fractional equity purchasing. And when we say long-term generational wealth, that really hits home for me because there are a lot of folks who haven't, thought that they could invest in and obtain real estate at a significant velocity by putting aside $500 on a monthly basis. Now, if that's what your budget is, $500, it might take you a while to save up to buy a rental property, but $500 gets you in on day one with city funds, and you can start having that nest egg that you've been looking forward to, and something that you can set aside for future generations. And then it's fractional. So we'll talk more about the fractional portion of this as we move along, but we are buying slices of primary occupants, single family residents all over the US, but we also have very specific regional funds. So depending on what your portfolio style is, you can put all of your eggs in Austin, let's say, or you can diversify through up to 8 different cities now. We'll talk more about that as well. But the main mission is to make sure that real estate is accessible for everybody in today's world, not just the folks who have insight to those special deals or like the BlackRocks. Nothing wrong with BlackRock in particular. Blackstone, BlackRock, both of them have significant real estate assets, but institutional money is different than our 401k or our self-directed IRAs or our portfolios. And so personal wealth should be able to built up with direct investments in real estate. That's what we believe. And it's a big market out there. $30 trillion worth of equity right now is sitting on the markets. In fact, I just saw something that came out from TransUnion about, I want to say about a week ago, maybe 10 days ago, since we've done this last webinar here. We do these about once a month, that said that number was closer to $32 million or $32 trillion. I apologize. $32 trillion in equity that's available right now. And there's very little competition to help homeowners extract that equity. They can do cash out refinances. That's really about it right now. And there's some problems with that. The mortgage companies, the banks, they want to, help you extract that cash if you're a homeowner, but they want to raise your interest rate significantly. Homeowners, if they don't want to do that, there's nobody else really competing for that equity, which means that we can come in, purchase that equity at essentially, below market rates. So that's our business model. We will purchase equity at a below market rate and then help investors find that, and we connect the two together. So, and we do that in very specific cities. So we're talking, well, we'll talk about them here in just a few minutes. In fact, we just launched a few others. They're in the ramp up phase. And just today, we saw news come out about Denver. Denver will be updating here. So if you're already an investor, that means something to you. If you're not an investor yet, that should also mean something to you, because Denver will have a price increase here that we've already announced. And if you're savvy, you can go check out the SEC filings. You'll see our price updates here. And it's a very unique situation where you can still purchase at $10 and some price updates are coming. We update pricing on the 15th and the 30th of the month, or the last day of the month if there happens to be 31 days. All right, so we created the city funds with an entirely new way for investors to tap into home equity in specific cities. And one of the questions we get very often is, why did you group these together in cities? Why not just have an individual house there that we can pick and choose? Well, we want to make sure that we offer a diversified portfolio. One of the greatest things about having a fractional equity is that for, let's say, $500,000, you might be able to go and buy one property, one rental property. If you wanted to buy a rental property, manage it yourself, find a tenant, make sure that the care is updated, make sure the insurance is good. You could do that with $500,000, or with $500,000, you could have $50,000 in 10 different homes. Now, unless all those homes are on the same street, the same natural disaster is not likely to impact all of them. So if they were spread out all over the city, you're diversified and you're protected there. Probably some downside protection just in case something happens. We do that for you automatically. So my team is on the acquisition side, and we find 10 times the number of properties that you would find on your own and diversify that. That's part of our service. That's what we do, and we believe in that mission. So we do find pockets in regional locations. Let's say Austin. It's not all in Austin proper. There are some surrounding areas. In fact, we use what's called the MSA. So the Metropolitan Statistical Area. So you get the overall Austin region, not just Austin itself. In some cases, Austin is the best, acquisition market that we can do. Or sometimes there's something in Round Rock, which is an up and coming area just outside of Austin that might be outperforming. And so we have some flexibility to regionalize those and make sure that we're finding the best opportunities for you. When you look at this map here, and when you look at the home equity investments, this one is Miami. If you look over on the right-hand side, you'll see, okay, we're in pockets there, but there's a good diversity. We're not just all in one neighborhood. And we want to make sure that we're protecting interests, and we do have some diversity there. So I mentioned home equity investments and fractional portions of homes, really single-family homes. That's sometimes, it's easy to talk about, but it's difficult to execute. And so how do you find and what security instrument do you use to just buy a slice of somebody's house? That's not been a popular idea in a very long time. And so we have developed a home equity investment. It's a very specific security instrument. We didn't invent it. We just made it better. It's been around since 2007, 2008. Some folks have had this in place, but in different formats. So the purpose for us, and I'll go through this, but I'm not going to read it verbatim. So we're going to provide alternate financing for homeowners. And really, that's really important for today's world. When you think about from a homeowner's perspective, and I bet some of you on here today are homeowners, there's a lot of ways that you could use the equity in your house. If you could extract equity, would you possibly reinvest it to put in solar or put in an accessory dwelling unit in the backyard? Maybe you can rent that out or Airbnb. Maybe you need a pool. It's getting to be summertime. What if you had a college age child and you weren't sure, should I take out a student loan or should I just pay for that with my home equity? What if there was a medical emergency? There's lots of different reasons why you might need cash quickly. This solves all of them simultaneously with a very quick and efficient format. There's very little diligence. It's not a credit product. So there's no diligence regarding debt to income ratio because there's no monthly payments. It's collateral driven. We're sharing in the equity of their house with upside potential. So it's exclusive. We mentioned that there's very little competition for this product, and that's true across the board. There are very few folks who are going to homeowners saying, "Hey, I'll give you cash for your equity right now." You might get a postcard from somebody who wants to like wholesale your house, the whole house, but very few people are saying, "Hey, just give me $75,000 worth of that equity there." And by the way, when we do that, homeowners are happy to give us 80 or $85,000 worth of equity for the 75 cash now, because the cash now is worth it to them, because there's very little opportunity there for them, and it's their equity, so they should have access to it. But that's how we make money for our investors as well. Not only we're hoping for the appreciation, but we buy it under the market valuation as well, and then we're aligned. So when you think about a rental property, in fact, let's set aside rental properties. Let's talk about something else that we're all familiar with it, because I just saw an article today about Hertz rental cars of all things. So Hertz rental cars, they're selling their cars, and they're used, but they were rentals. And the knock against buying a rental car, on the secondary market is that it wasn't taken care of. And why wasn't it taken care of? Because nobody cared. Nobody had long-term interest in that car. They gunned it. They were dirty with it. It might not have had the best care because it was a new user every single day. Nobody took long-term ownership of that particular vehicle. Well, it's the same thing with a rental house. If you have renters that come in, they're not going to be there maybe in 2 years or 5 years. So, they'll slam that door a little extra. They'll run the AC all the way at max. They won't clean the ducts. Those types of things that a homeowner will do, who takes pride in their home ownership, who takes care of, they buy nicer appliances, they get the roof gutters clean, they make sure that the yard work is done. We are aligned with homeowners who take pride in their home because they live there. And so we want the home appreciation to go up. And it works a little something like this. If we get a percentage of their house, let's say it's 15%, right? $1 million property, we gave them $150,000, 15%, just rough numbers. We want their house to appreciate because we get 15% of that. Every dollar their house appreciates, we get 15 cents for all of our investors, for all of you. Now they still get 85 cents for that appreciation. So we win, they win. We all want their home valuations to go up. Now, we're in the money on these things. I mentioned earlier, and I kind of touched on it, that we might give you $70,000 or $75,000 for $80,000 or $85,000 worth of equity. And that's worth it to our homeowners right now. And it's worth it to you as an investor. Hopefully you make that decision and you say, yes, you know what, that's an instant swap I can understand. And even if the house value goes down a little bit, we have that 10, 15% kind of cushion there. In fact, it's even greater now, because of the way that we're purchasing these. We have downside protection in most cases on new assets down to 40%, sometimes greater. So the house value would have to come down almost 50% before our investors would realize a loss. It's still a security. There's still risk there, but we do have greater downside protection now, and that's really important. We want to make sure that our investors have, a solid foundation to work from. And then it's secured. So this is an actual deed of trust in the state of Texas. Various different states call it something different. 90% of the time we're in second lien position, but it's an actual lien on the property. We close with the title company, it's official. And then 10% of the time we're actually first lien position. We are the sole lien holder against the house there. We're the only other investor, so to speak, in that property. And that's really important because it means that should something happen to that homeowner, we have a legal claim on the house itself. Now, we're never really, looking to foreclose on somebody. That's really the last thing that we want to do. But we do have that option so we can protect your interest. And because we have downside protection, in most cases, the house could sell for in an emergency situation for 30 to 40% less than the retail value, and our investors still realize gains. So we have some protections built in there for you. I do see a few questions. I will make sure I save time for those. I mentioned at the top of the hour that I will make sure that I pause here at about 20 or 25 minutes so I can answer some questions. So I see them, and thank you. So home equity investments, and that's really my passion topic. So if anybody has other questions about that, feel free to use the Q&A section there. I will get to those. I love circling back to those. I do want to make sure I get through everything here. So traction. So since City Funds was SEC qualified in September of 22, that's when we were SEC qualified. Some of you actually came from Republic, started raising money in 2021 for the parent company, with the idea of bringing this to market in 2022. So the original investors allowed us to do the legal work, the due diligence to put the construct together. And since 2022, we've been live with at least 3 different funds. And now you can see on this screen, we've actually got 8. And we've got Select and Yield for accredited investors, which offer some different features there that we really think are we want to test pilot there before unleashing for everybody. This says that we've onboarded 20,000 investors. It's more like 25,000 now. This number here is about 4 months old, 5 months old. There's an accelerated pace of about 1,000 new investors on a monthly basis. And by the way, these are open-ended funds. So if there's new investors coming in, some people ask, hey, does that mean that I'm getting diluted in some way, shape, or form? Like as if the money goes in, but it's only the same amount of assets? Well, the answer is no, because we're always obtaining new assets. That's the beauty of the open-ended fund. We can just keep growing, and as every time new money comes in, we can make new acquisitions. In fact, we have a whole originations team always looking for new acquisitions in select markets. Right now, you'll see here Dallas, Miami, Tampa, Austin. Los Angeles is very interesting. We just got our first deal in Los Angeles. Denver, I mentioned earlier, is going to see the first pricing update. So if you were one of our early Denver investors, then you took advantage of likely some early offers, early bird specials. Maybe you have a few extra shares there. You should see those get updated. I believe it is the very beginning of next month, if not the middle of June. So you'll see that get updated here. We have several acquisitions that have been made there. And typically we need to see those season just a little bit to make sure that our valuations, our estimates are solid and consistent. Phoenix is next. We also have some assets that we've just purchased in Phoenix. I believe that's still in ramp up stage. Nashville is brand new. So Nashville doesn't have any assets in it yet. The only way to obtain Nashville was to invest through our WeFunder campaign. And even then, it was as an incentive, it's future shares in Nashville. So Nashville will go live, but we don't have boots on the ground there. And we strongly believe that we only want to invest in markets that we fully know and we're familiar with, and we feel like we can make strong, solid investments for. That's another point. I've got about 6 or 7 minutes here before we start answering some questions. But I do like to mention that we invest in what we know. There are oftentimes there are other opportunities out there, and we're aware of them. If you want to invest in public storage or commercial space or multifamily, those are all solid investments, and they all have a place in portfolios for those who are comfortable with those. It just so happens I've got 25 years worth of real estate housing, primary residential experience, primarily from mortgage, financial history, fix and flips, those types of things for single family homes. Our CEO, same scenario. He also has that type of experience. And we started off in 2018 as a discount real estate realty company. So we have, actual real estate agents on staff. Our acquisitions lead also is mortgage licensed. All of our staff either carries a Series 7, Series 65, 63, or an NMLS license or a real estate license. So we all have our specialties, but they all revolve around single family residence. That is our niche. So not that all of those other things shouldn't be in your portfolio, but we know single family residence, and that's what we specialize in. So we just want to make sure that, we stay in our wheelhouse there. And that's good for you as well. So you've got somebody who's on your team who understands that particular asset. So getting started. You can get started in minutes by downloading the City Funds by Nada investment app. It is available on Apple, Google Play, and there is a new version. So if some of you are previous investors, please make sure that when you log in, you update the app. There have been a few reports of the old app not connecting correctly to the appreciation matrix, which makes it look as if your investment were static. So we have caught that. New versions are automatically updated. It's got some really nice graphs, charts in there if you want to track your investment. You can track it all together as one portfolio or individual by city. And it's really easy to connect your bank account via the Stripe integration there, or pardon me, Plaid integration that we have there, and it's pretty straightforward. And this hasn't been announced yet, but you lucky folks who are on here now, this has been a high demand request for a lower point of entry instead of the $500. And in fact, at various points in time, it has been lower. It has been as low as $10, which we found it was unsustainable, too much friction with our money movement suppliers. The volume that we were doing didn't make sense because we were charged per transaction. Same thing at $100, really. That didn't make a whole lot of sense for us as far as cost of acquisition, to make sure that the funds were still, profitable. As you invest in funds, you want to make sure the funds are behaving responsibly with marketing and obtaining new investors, because the funds do share the burden of that cost. And so we've moved that up to $500 for one-time investors. However, there's going to be some movement there for recur and earn investors. So this has been one of the biggest, the most often requested feature is, hey, is there going to be some kind of, lower price point or recurring, incentives? And there will be. I believe we're probably 30 to 45 days out from getting that fully launched. Maybe sooner. We'll see. But yes, we've heard you, and we are launching a recurrent earn option there. So keep that in mind. All right. Questions. It is now 6:21. I am on pace, on time. So let's move over to questions. Gabriel, I see you here. In fact, I think this is probably what I just ended with. I see the investments amount is 500 and it used to be 100. Yes, so Gabriel, you've been with us for a little while. It did increase from 100 to 500. It will go back. You'll have some options there. And we want to make sure that, hey, if you're dollar cost averaging, if you've got, a particular, investment plan that's available to you, we want to make sure that we're accommodating that, but we also want to make sure that we are being responsible with the fund's marketing budget and making sure that works out for everybody. But yes, you paid attention, and I appreciate that. Stephen, how many years before the homeowner must pay back the HEI? 10 years or more? Stephen, this is an interesting conversation. So we talk about velocity a lot, and what to do if there's payoffs, and what what to do with a homeowner who possibly has come to the end of their term. So a couple of layers here. Number one, the average person who keeps any kind of real estate transaction on the books is about 6 years. There's some variation, if it's a high interest rate environment or low interest rate environment, but between 5 and 7 years. So we split the difference and we say 6. So, and studies have shown since 2007, since this security instrument has been in existence, by year 10, 99% of these have paid off. There's been resolution or exits of their own accord for whatever reason. But it is a 10-year agreement. Now, at the end of 10 years, in our contract now, it specifically states what their options are. And we will reach out proactively at about 9 years and 6 months. So about 9.5 years in, you'll get an email from Sundance Brennan representing NADA and says, hey, it's almost the end of your term. You've got some options. As a quick reminder, they are, you can sell the house. We have a real estate company. We will happily offer you discounted services there. You can refinance with a traditional mortgage. We are a fully licensed brokerage firm. So I can help you get a regular 30-year fixed mortgage, or there's lots of second mortgages. And this has been of high demand lately. We've had a lot of folks who are not quite of retirement age who want to use a home share to access equity prior to getting a reverse mortgage. And so we have a reverse department as well. So we can offer you a reverse mortgage, which pays off the home share. And there's still no monthly payments for those homeowners. So it's great. You can also get a re-home share, we call it, meaning you just really extend for another 10 years. Now, there are some benefits for investors. We recapitalize that at the current valuation. Whatever the payoff balance is, gets updated with the current percentage of equity. So for investors, it's a brand new transaction, and they get to rebuy into that same property, but in the money again. So they get to realize the gains and then, enter back into it as well. So homeowners have options. In fact, we monitor that proactively. We have a licensed servicer who manages actually typically mortgage transactions. This is technically a mortgage. It just doesn't have a note attached to it. So hopefully that answered your question. They have 10 years to pay it back. We proactively monitor it. And our history, a lot of us come from portfolio management companies from the mortgage industry. So we know how to time these things right. And there's lots of really cool algorithms so that we can swoop in and, cash out and exit that agreement so that our investors can realize those gains. And if you want to, in the future, you can reinvest those funds again. But you're also going to see dividends and payouts and some really cool things that happen once we have velocity for those. All right, Stephen, if you got any other questions, I'll get to those. I'm going down the list here. Okay, so how does City Funds make money? I think if I hit this button, it might actually show up on the screen here. So City Funds makes money. I've touched on it a little bit. City Funds is the asset or the manager. So City Funds has a 1.5% management fee that's annual. It's not like you put in, $100 and we take $1.50. So it doesn't work that way. We actually take it on the annual. Only, if we're making money for you as well, will we see, that 1.5%. So it comes off of the top line, it comes off of the bottom line, not the top line. So when you invest in City Funds, $100 goes towards the assets. So that's how City Funds makes money. There's a couple of other small items in there. There's a technology fee that gets added in there for some of the platforms, but it's really kind of incidental. City Funds for us is not a huge moneymaker, quite frankly. Our business model, nada.co, is the manager of City Funds, but really it is not it's a no load fund. So Nada originates home shares, which are the home equity investments for homeowners. Homeowners pay us. Homeowners pay 5.5% in a lot of cases to close one of these transactions. So it's not the investors that pay for any kind of a profit for the company to keep going. It's the homeowner side of things that actually covers the cost of our originators and our sales folks. So the burden is not on investors. The burden is on the actual homeowners. Hope that makes sense. All right, let's see. Next, we've got Gabriel. I don't see the new city in the app. Gabriel, I did mention earlier, make sure you go in and you hit the update button for your most recent app, and you should see coming soon. You can also go to cityfunds.com. The city funds that are coming soon may not be on the app yet, like Nashville, because it's not actually active. We've just got a picture of it, I think, on the web app. So you may not see it if it's not available for investing yet, but I promise you they are available here in the I don't know very near term future here. And Denver is live, so you should see Denver. If you don't, go update your app, please. Gabriel, another question for Gabriel. Are dividends still given out? So the very first dividend has been released. Is only for the yield fund. Most of our funds are what you call growth funds, meaning they're meant for long-term holds for significant gains. So dividend or cash flow funds are what yield is. It's a lower percentage, but it's very consistent. So if you are an accredited investor, it's very easy to get into yield. I believe it's somewhere between 7 and 8% that it's paying out currently right now, which is fantastic for a very consistent, very reliable cash flow style of investment. City funds themselves are growth funds. We recommend being willing to hold for at least a 2-year period. We don't have any particular hold time though. That being said, we also don't have secondary markets open. We launched the first ones in September of 2022. So it hasn't been 2 years yet. And really we need to get to about, I have a number of about 100,000. It's probably less than that. 100,000 would be good, I think. But you don't want us to open up a secondary market before we have that many. Otherwise, the pricing will just crash, right? There won't be enough people to sustain that secondary marketing. So we need a critical mass of folks in order to make sure that there is a healthy secondary market for these. And we're still buying or selling a significant amount of these at the initial price of $10. So there's as we're done launching all the new funds, there's none left at the $10 marker. Then the secondary market really makes sense, and then people can exit and get back in. Gets much easier. Until then, though, I really strongly recommend that you count on about 2 years, just so our team has enough time to actually invest it into a house and maybe see some gains from it. But 14, 15% IRR is our target. You're not going to see that every single year or month in, month out, but over time, you should see that based on our strategy. So dividends are only given out so far for yield. There will be dividends, though, announced in the not too distant future, in all likelihood. I believe probably the first city funds that were launched were Dallas, Austin, and Miami. And I think probably Miami is the closest, right? So without telling you any specifics, because we don't know and it hasn't been announced yet, but I would suggest that Miami is probably the closest to having the first dividends, just based on age, number of acquisitions, and the performance. But yes, there will be dividends for other city funds as well. All right. How many HEIs have you invested in, and how much total capital does this represent? Total dollars invested. So AUM is now close to $11 million. Total invested is, I think, 7.5, something along those lines. Pretty close to that number. So you can see, okay, well, it's not hard to do the math. If only 7 million, 7.5 million got invested, but it's worth 11, those are the generally the gains that you would see there. And you can see that, and you can track that with NAV. And so that's updated on a regular basis in the app itself. How many HEIs have we invested in? I think was the first part of your question there, Stephen. 120 something. It's we're closing these on a regular basis. We're closing. I think we closed, I don't know, 4 or 5 last week, and it's Thursday this week. We've already closed I think 3 this week. So we're closing these on a pretty regular clip now, and it makes it easier when there's new money coming in. We can make acquisitions. We have a pipeline. We have a waiting list of 30 million. Now, not all 30 million will meet our criteria, but we have $30 million worth of home shares that it's on the wait list right now. And in our pipeline, we've got about 3.5 million active in process right now that's still pending to close in the next 45 days or so. So Stephen, we've got quite a few in the process, and we're going to ramp up that number exponentially in the not too distant future as well. All right. Last question I see here, and good timing because it's 6:32. I think I told you this would be about a half an hour. So Gabriel says, "What's the best performing city?" Gabriel, they're all my favorites. I don't know which one has the best IRR to date. They all launched at slightly different times. Miami is doing pretty well, though. As I mentioned, I think Miami will be the first one to have a dividend. Now, you'll see when a dividend gets issued that the NAV price will go down because we don't have quite as much cash because we distributed it. But I think that Miami, for like my personal preference, I like the balance of having possibly a dividend and seeing those gains, just from the equity in the property. So from that perspective, I think Miami is done really well. As far as the most assets that we have, I think with the most upside potential, I like Dallas. I'm from Dallas. I know the markets here very well. We have a huge backlog of properties in Dallas, and so we can be very selective when we invest in properties in Dallas. And just being here, we study the economics of the area that's being impacted, and I can tell you the number of jobs being created and still growing in Dallas, for right now anyway, seems to be outpacing Austin. Austin has actually seen a little bit of a pullback in economics. The number of employees and employment growth is really kind of one of those key factors that we think is underutilized when determining real estate valuations. So anyway, we like Dallas for future growth as well. Maybe not necessarily the best IRR so far, but potential. I personally like Dallas. Now, that's not going to be the gospel, so please don't hold my feet to the fire there. Not specifically financial advice for you, Gabriel, but I do like Dallas a lot. All right, I think I can close all of these now. And if there's any last questions, you got a few minutes where you can still run those through. You should see my friendly face on there along with Dion's. Dion's not here today, but you can email either one of us, Dion@nada.co or Sundance@nada.co. I manage all of the revenue activity, so I'm the guy that tries to help make you money. And Dion is our investor relations specialist. We both carry Series 7, 65, 66. Joe, you're asking a good came in under the wire, Joe, for replay available. It probably takes us 24 hours to get this up on the Not a Finance YouTube page. If you can, just Google search Not a Finance and you'll find our YouTube page there. You'll find some of the previous webinars. They didn't all have captions, and most of the time you'll see Dion handling these, so you will get a little bit of timely information, a slightly different perspective when I perform this. But you'll see some of the old webinars, and this one will give us about 24 hours to post it there. They also, Joe, send it out in an email. So if you're on our City Funds list, if you put the information in there, you'll get an email probably on Monday with the link there. Stephen, how long does it take for the homeowner to get the funds after initiating the process? It takes about 45 days, 45 to 60 days to close on a transaction like this, Stephen. There's quite a bit of due diligence regarding the collateral. So we don't really care too much about their income level, as long as they have enough income to make sure that their homeowner's insurance is paid, so our collateral is protected. But we do a full inspection of the property. So just like when you go to purchase a house, not just an appraisal, we pay an inspector who crawls in the dirt underneath or goes down to the basement, goes up to the attic. The level of intensity of an inspection is much greater than you would have from a just an appraisal. And most of our files, quite frankly, come back with some necessities, some deferred maintenance activities. And I would say probably at least half of our files have some type of home improvement project attached to them, which is nice for investors, by the way, because if I was an investor, I would want to get equity purchased right now before the home improvement, so that after, like, I'll give you the cash for it, and then you're going to go put on an addition, so the house value is automatically going up. I think that's great. But yes, we do have about 45 to 60 days to inspect the house, make sure that we cure any deficiencies there. We also run a full title report to make sure that, hey, are we really in second lien position? We want to make sure that nobody else can supersede us. A few times we'll run into like tax liens, and we cure those before any investor gets involved, so that we make sure that our interests, your interests, are protected. Good question, Stephen. Martin, is the company profitable? The Topco company is not profitable on a long-term basis. We probably need to do about $5 million, somewhere in that neighborhood, before we do that. But hey, Martin, stay tuned. We've got our Series A is the next step for us. So, like most companies who are launched and venture-backed. So we are venture-backed, which means that we've got some deep pockets behind us to make sure that our idea is solid, and that moves forward. Now, city funds are profitable. Every single city fund is up. So we manage the funds. So you, the investors in city funds, have made more money than our venture capital firm at this point in time. And city funds are wholly separated. So they are bankruptcy protected or anything like that. So even if I went away with nada, our venture capitalist firm would be very unhappy, but you as city funds investors would live to see another day. The city funds manager would still make sure that you're taken care of. That's the beauty of having real world assets back your investment. All of these security agreements are real assets. They're all against the physical property. So you have a lien on all of these properties. So city funds investors are actually in the green. Nada investors, not so much yet. There you have a very transparent answer, Martin. All right. 6:38. Good group. I appreciate all the questions. I'll stall for another 30 seconds if anybody else has any other questions they want to give to us. Otherwise, have a great Thursday. I appreciate your interest in city funds. Thanks to those of you who are already city funders, and keep an eye out. We do have Denver updating next. We have new cities coming out, launching, I think in July, probably the new city will go live. We've got a few that are ramping up. You'll start to see those updates start to go live. So you'll start to see gains being realized. It takes several months for those gains to get realized, by the way, sometimes up to 6 months to acquire the assets. Because when we open up a fund, I might only get, I don't know, $40,000 that day one. And that's not quite enough to go out and purchase some slices of equity. So we really need to get a decent amount in the fund so that we can go acquire these assets and then pool them together and make sure that we can report NAV. And we need to make sure that's a diversified pool for you. All right. Well, as always, I appreciate all of the questions. My name is Sundance Brennan. Happy to answer questions offline as well. Sundance at nada.co. Again, there's my contact information. Have a great day and thanks again.